Well, I see the numbers are starting to level off. So why don't we get started? Good afternoon, everyone. A pleasure to have you all here for today's webinar. My name is Matthew Eby. I'm the founder and CEO of First Street. Um, and we're here to discuss the latest potential developments of what would happen with FEMA, the National Flood Insurance Program, and what those impacts could mean, depending on the change overall to the American economy. So welcome. Thank you for being here. And really, when it comes to the FEMA and National Flood Insurance Program and these changes, it's a consequential policy shift in the history of recovery funding in the United States. The current administration has proposed eliminating FEMA's disaster recovery fund for states, which recently has also been walked back a little bit. But we're here to discuss what would happen if that were to take place. So where would this burden fall? Would it fall to the states and the individual investors? How would companies react? How would individuals react? And what could the states and cities do? But it's more than just a budget change. It's a systemic realignment of how disaster risk is managed and financed. So for decades, as we all know, FEMA has been the backstop for stepping in after disasters like we saw, unfortunately, in Texas recently, which has made the conversation even more urgent. And it seems like that is the place to really lean in, is that that has been the backstop. What happens if that backstop is removed? So we're going to be taking some time today to talk about all of these ripple effects with the NFIP program and private carriers, and what would happen to regions that would face the greatest exposure. What could that look like across the board? And what would happen with investors and lenders with property level climate risk data, and how do you mitigate this potential issue overall? So we have three perfect experts to answer these questions for us today. I'm going to pass to each one to do a quick introduction of themselves. And then I'll take it back and then start diving in with some questions and pass it around as we go. Some housekeeping items for everyone. If you would like, there's thousands of people that have registered. So please take that in mind when you're entering questions into the chat, but please do put questions into the Q&A chat. That's where we're going to be looking to try and pull some out and surface them at the end. We're going to reserve 10 to 15 minutes at the end to try and answer your questions, but we'll use some of the initial conversation from the main topics that we're all interested in anyways. Outside of that, please just enter the questions in the chat. We'll end right at 1, and I will pass it over to my colleague and friend, Dr. Jeremy Porter, to kick us off with a quick introduction of himself, and then we can pass it to Dr. Kaniewski, and then Mr. Weaver can conclude.
Great, yeah, thanks, Matt. Glad to be here and on this panel. So I'm Jeremy Porter. I'm the head of climate implications research here at First Street. I work directly downstream from our climate science team, where my team really focuses on the downstream economic and social implications of climate risk. A lot of the reports that we end up putting out are focused on some of those economic impacts, the sort of downstream materiality impacts, and I'm happy to be talking about some of our talking points from our analysis of FEMA data compared to First Street data over the years, and what a change in the program policy, whether it's a new look to FEMA or whatever lies ahead may look like, or the implications of that. I can pass it over to Dan.
Thanks, Jeremy and Matt. Dan Kaniewski. I'm at Marsh, McLennan, where I focus on the public sector market. And my passion is disaster resilience. That passion is fueled by 25 years and various industries focused on disaster resilience, including about 5 years ago, right when I joined Marsh, I had left FEMA as the first deputy administrator for resilience, which means I oversaw all of FEMA's pre-disaster programs. So excited to be here. Jeff, over to you.
Yeah, sure. The underachiever of the group. I don't have a doctor in front of my name. But Jeff Weaver, I'm an executive vice president and managing director of KeyBank Capital Markets at Key. Most of my time at the company in risk management, more recently over the last 4 years, establishing and building out the capabilities necessary to identify, quantify, and manage climate risk. Prior to that, some 10, 12 years thinking about the potential for outsized portfolio loss from a credit portfolio perspective. Thus, my association with the International Association of Credit Portfolio Managers, where I was on the board for 11 years and served as the chair of the board for a couple of those years. It's based in New York with a significant amount of operations in London and Europe, and happy to be contributing.
All right. Well, thank you so much, everyone. So to kick off, why don't we start with the proposed elimination of FEMA disaster recovery funding and what that means for local governments. Can they absorb this responsibility if this were to actually happen? So Dan, I'll throw it to you to kick us off. As a former FEMA deputy administrator, which you were just talking about it, how do you view the state and local capacity to fill the federal vacuum if that were to take place? And secondly, what operational or funding gaps do you foresee if that were to take place?
Sure. Well, let's just level set. I mean, FEMA and its programs are all codified in statute. It's the Stafford Act, right? So this is a statutory basis that would require any significant changes would require Congress to act. In that statute, it says governors are in charge. It doesn't say FEMA's in charge, it says governors are in charge. It also says that FEMA is to provide supplemental assistance as directed by the president. So if there were a presidentially declared disaster, FEMA would be directed by the president to provide that supplemental assistance. And how we described it when I was in the first Trump administration, we coined the phrase locally executed, state managed, and federally supported. And I think that summarizes, again, how we viewed that in the last Trump administration. But I got to tell you, a lot of what I've heard still fits with that narrative. The locals are the first responders, the states manage a larger response, and the federal government supports when needed. And those are usually pretty rare instances where federal support is needed. But since you asked about disaster recovery funding, I would hate to see this as an either or, right? Either the status quo, which is 75% of disaster losses for a presidentially declared disaster are covered by the federal government, and the states and localities cover the other 25%. That's kind of the status quo. I think a reasonable conversation to have would be, is that the right level of burden sharing? And there's views, I'm sure, to be heard on many different sides. So let's take, for the sake of argument, shifting from 75-25 to 50-50. I don't know. Is that the right split? I think the real conversations, regardless of the outcome, assuming it's not a catastrophic outcome, meaning zero federal support, I think any reduction in federal support, whether it's 5% or 25%, that causes conversations to happen between state and local governments. In fact, those conversations are happening right now. There's evidence that local governments that are obviously concerned about this are having conversations with the states about appropriate burden sharing between them. And, who fills the void if federal funding is reduced? Should that directly impact the local communities? 100% of that burden lie with the locals? Probably not. Should the state be able to step up and provide some level of support? In general, yes. But the reality is that regardless of where the federal government falls and where the state and local governments would fall in, let's say, a negotiation about burden sharing, it's going to take time to adjust. You can't just flip a switch and say, oh, light switch off, no more funding. There needs to be time to budget for these sorts of things, and potentially multiple budget cycles, multiple state and local budget cycles to absorb the impacts of any policy change. And I know it's easy for us to catastrophize and kind of doom and gloom about that. I mean, if I was a local community, I would be very worried too. But the flip side is there are communities that have taken a proactive approach for years. And they've been taking charge of their futures without prompting. So I think it's equally important that we highlight those communities and those states that have done the right thing. One off the top of my head is Babcock Ranch in Southwest Florida. It's a disaster resilient community. It was built that way from the ground up to be resilient. And they've proven that their model works. They've been hit by hurricanes with no impacts. So to be successful, I would say we collectively need to realize we need to take action. And ideally, we need to incentivize these communities to take action before a disaster strikes. And that was what BRIC, or the Building Resilient Infrastructure and Communities Grant Program that I launched at FEMA, was all about. And I'm very sad to see that go away, because I think it did a good job of incentivizing communities to do the right thing. But there are state programs like the Strengthen Alabama Homes program, a wonderful program that helps homeowners retrofit their roofs to make them more disaster resilient. And I think there's things that all of us in our various industries can do, particularly the finance, insurance, and real estate industry, what we can do to incentivize communities to make these investments absent federal funding.
Dan, do you mind expanding on the local community that you mentioned there? How are they able to do that? Like what did they do differently that others don't, that allowed them to be that resilient community that you would call out as kind of the gold standard or the right way of doing something at the local level?
Sure. The developer made a conscious decision to build a disaster resilient community, to build this community differently. They took a plot of land and turned it from nothing into a community, which that happens every day, especially in Florida. Homes are constantly going up, but they built these homes to resist the impacts of the disasters that they could face. So that'd be flooding and wind events. And history over the last 5-6 years, they've been hit by a couple of major storms, and they haven't had impacts, which tells me what they're doing is proven true. And so kudos to them, kudos to the developer, the investors who made that conscious decision. By the way, it's also a community that's entirely powered on solar. So when we talk about resilience, I talk about disaster resilience. There's a different type of resilience, that we're talking about there. The climate resilience aspects of that community are also quite notable.
It's a really interesting concept of the ground up, like the ability to start from the beginning and build it properly, which obviously exists in certain situations, but for the vast majority of the infrastructure built today and the properties that have been built, we have already made certain decisions. So Jeremy, maybe I could flip it over to you in the research that you do and lead at First Street. What is the potential community level fallout that you see, especially in places historically dependent on these federal recovery support dollars, which are based off of being impacted and built in the potentially not to the right standard, or in places that we didn't have standards before, and then they're impacted and then they need that support? What would the potential fallout be for those higher risk areas? What does that look like?
Yeah, thanks. And I really like the points that Dan's making around the communities that have been built to be resilient. Some of the successful programs, like the one in Alabama, oftentimes gets called out as a program that does show that this can work if we are building resilient and incentivizing people to build in a resilient way or retrofit in a resilient way. Ultimately, what we see if we look back in the data from our work on the First Street side is that when we see climate disasters, and ultimately the role of the federal government in terms of providing disaster community funding, individual assistance grants, the type of funding that generally comes into communities and gets the communities back on its feet, or at least gives it a little bit of financial support to hold residents over until, in some cases, they figure out what to do next, is that funding is necessary. I mean, many communities, whether it be smaller states or states that don't have quite as large of a GDP as your Texas or your California or some of your other states, they rely heavily on this community disaster recovery funding following an event. And when you start to couple that with some of the points that you were just making, Matt, around building code implementation, when the structures were built and have or have not been retrofit to be resilient to the climate disasters that exist in a specific area. Lots of times what we end up seeing is that it is the properties that were built prior to those building codes that take on the most damage. I mean, we're thinking about properties just recently in the Texas flooding. Many of those buildings that were impacted were over 100 years old, close to 100 years old. And ultimately, when you have the flood zone come in, the flood zones, in the area, I think it was from 2010, 2011 or so. Those buildings weren't retrofit to the design standard, the base flood elevation standard of the properties that would be built today in the same area. So ultimately what you end up seeing is those buildings gets damaged, and it only gets amplified if we're not capturing risk properly. So if risk isn't being captured properly via the creation of FEMA zones or special flood hazard area zones, then oftentimes the property owners themselves don't realize they have risk. They don't adapt to the risks that exist, and they don't insure themselves for post-event recovery. So there really is this sort of combination of not knowing that you have risk, and then the age and the vintage of the structures that exist in an area relative to the known risk and the changing risk, to be frank, that we're seeing over time. As we move into these different communities that are less resilient and aren't built to a design standard that would protect them from the disasters that they're exposed to, our work on the sort of economic implications and macroeconomic implications side shows that oftentimes we do end up seeing an impact on things like GDP, HPIs, debt to income ratios, other metrics of economic health that exist in the community. But where you have really strong sort of macro environment, ultimately we see a rebound in those spaces. And a lot of that's driven by the fact that following a federally declared disaster, money comes into the community. Money rushes in to help property owners rebuild. It helps the community rebuild. Infrastructure is redeveloped. But in places where you don't have the strength of that same macroeconomic environment, we tend to see persistent declines in some of those metrics. So, oftentimes the community recovery, in the absence of state funds, state reserves, local community reserves, is almost entirely dependent in a lot of cases on those federal funds that come in into the communities. And some states are better equipped to manage it than other states. So ultimately, what we're likely to see if we were to reduce the amount of federal funding that comes in following a disaster is that there would probably be some inequality in terms of how communities could recover. Some states, I think, would be able to manage it better than others. Others wouldn't be able to manage it, and ultimately those downstream effects of climate migration, potential population composition changes, tax revenue impacts, commercial viability, all of those things that are downstream of some of these disasters and risks that we're just starting to get a handle on as indirect consequences of climate risk would be amplified in some areas and potentially wouldn't be as impactful in other areas. So in a lot of ways, the federal disaster recovery monies help to sort of even the playing field in terms of recovery when we do see these types of events.
Yeah, which leads us perfectly into a question for Jeff on the idea of transferring disaster costs to property owners and banks and investors. And if that were to happen, how does that reshape the financial markets and, more importantly, housing affordability? Because obviously you're going to see a much different swing on premiums and all these other things that will come to the individuals themselves. So from a banking perspective, what are the key implications for collateral value, credit access, and risk modeling, particularly in regions like the Midwest?
Yeah, excellent points about the old norm and the new norm made by the two other panelists. I would say the following: to the extent you're contemplating a redistribution of disaster recovery costs, it makes the presumption that the traditional actors, property owners, municipalities, lenders, and investors had awareness of those risks and the potential costs prior to entering into the relationships. Right. I recall when I got my mortgage some number of years ago, I got asked two questions by my lender: do you have an insurance, and are you in a flood zone? If the answer was yes to the first one, we're good. If the answer was second, to the second question was something other than the no, then I got a third question, and that was about it. And now you have some understanding or notion where you now need to understand these other new risks that the actors hadn't contemplated. So, so from a banking perspective, especially in the Midwest, which has the perception of being sort of moderate to low as it relates to climate-related implications from climate change, there could really be three ripple effects. And I think you're right to sort of center on the three areas of focus. From a collateral valuation perspective, collateral value could become more climate sensitive. You could have this instance, for example, I live in Ohio, in a flood-prone area like the Ohio River corridor. Property values, may begin reacting more directly to perceived sort of issues around climate, particularly if insurance starts to take those factors into consideration. If it becomes, more difficult to secure or expensive. So insurance maybe, some number of years ago might have cost, $800 a year, and now it costs $5,000 a year. Should that change impact value? And, should we be thinking about that at the time of underwriting in terms of appraised value relative to actual risk-adjusted market behavior? I think about the last time I went to Zillow, and I saw, sort of the score at the bottom of the page that said the flood score was higher than 7. I didn't look at the property anymore. Should that be introduced into underwriting and portfolio management? I think the other thing to contemplate is what I would describe as sort of credit access, and would that begin to tighten? Certainly in high risk zones, insurance premiums already account for, sizable share of borrow income, potentially sort of having to be redirected to recovery. If that trend continues, could it reshape affordability models? Could it strain quantification of thresholds? While some lenders are piloting mitigation loan products, others might be looking at DTI framework adjustments. Most are not. And so, that concept, these issues could impact standards across the industry. Finally, as it relates to financial markets, I think to the comments earlier, they didn't focus on this issue because it had the ultimate backstop, a federal sort of insurance support for the high risk areas, or for those areas where climate might become more of a contributing variable. We've begun to see mortgage-backed securities essentially that are sort of backed by flood exposed collateral, traded at a wider spread. So essentially, whether these trends persist or not, it suggests you need to begin to model them. You may need to disclose them, and you may need to take them into consideration in terms of how you mitigate in the capital stack. If disaster cost transfer becomes the norm, something that was thought to be in place to support the public good now needs to be priced as a credit concern. One that influences, I think, potentially, as I said before, housing access, property liquidity, and long-term affordability across regions.
Yeah, and it at the core of it, I always think of it, Jeff, around the cost, like you're talking about, the cost going up dramatically. You have a long-term loan, 30 years in many cases, and so this idea of all of a sudden a rapid shift in pricing changes and underlying valuation or credit worthiness that's then being tested with the information that wasn't included in the original loan is really at the heart of it. I think the biggest question is like, what happens then? What do you do, because it's kind of already in the system, and what is the fallout of that? So maybe if we kind of move to the implications of the National Flood Insurance Program itself, because that's really at the core of what would happen here to the broader insurance landscape, because the insurability is the thing that then de-risks the loan in the first place, which is why it's mandated for you to have it if you're in the SFHA, or why you have to have homeowners insurance overall. So, maybe Dan, you could set up to us, how FEMA's disaster recovery function and the NFIP are interlinked, and then the long-term consequences of federal recovery support if that's weakened. And then we can get into more of the insurance side of it with you, Jeff, as we follow up on that one.
Mm-hmm.
Yeah, just like FEMA recovery programs are codified in law, so is the National Flood Insurance Program, different law, right? So in my view, regardless of what happens to the agency, the program, for example, NFIP, will still exist, right? And I say that for a lot of reasons. One is the administration nor Congress has made any comments that I'm aware of about near-term reforms to the NFIP, for better or for worse. Listen, I think the NFIP is badly in need of reform, but in this case, it's probably good that it's not caught the attention of the administration or Congress at the moment. But let's say worst case scenario, FEMA goes away. I think NFIP still exists. And I think that those FEMA IA programs that Jeremy mentioned, the Individual Assistance Program, those are for individuals that are uninsured against flood risk. So if the FEMA IA program is rolled back, fewer disaster survivors would have that safety net, and that's obviously a concern. But I think there would still be NFIP. Now, what should happen? Well, the private flood market should continue to grow, right? It's on an upward trajectory. And risk rating 2.0, the one that created some risk-adjusted rates, it made the marketplace more desirable for the private market. So say what you will about risk rating 2.0, but it's bringing the private market in. However, that trajectory that we're talking about, the upward climb of increased number of private flood policies, it can't go straight. It can't go vertical. And I don't feel that the private market could suddenly fill the void overnight if NFIP went away. So bottom line, I don't see this as kind of an either or situation, either FEMA assistance programs or NFIP, or NFIP versus the private marketplace. I think NFIP is necessary for the near term. Define near term how you want, but it's necessary for now. And probably for the long term, I think as your report stated, it's still going to be necessary for some high risk properties. And the private market hopefully will continue to grow over time. But bottom line, we need both the NFIP and the private flood market to fill the significant flood gap that we have here in the US.
Yeah, and I guess I totally agree. One of the questions that I was first kind of getting to, and Jeff, I'd love you to weigh in on this now, given what Dan just went through, is like insurance instability is really at the core of this. So if you don't know what the prices are going to be over time, whether it's climate related or policy shift, or for whatever reason the risk rating 2.0 or the NFIP program had you at $500 a month, and it's actually the private companies think you're at $7,000 a month, and you have this instability or this delta between the two. That's really the thing that can affect investor confidence. So from your perspective, Jeff, how are lenders responding to that increased uncertainty, whether it is climate related or policy related, as we're talking today?
Yeah, if you don't understand it, you can't measure it. There is some degree of volatility or variability in how it might show up and manifest in a loan portfolio. You don't want to own it on balance sheet. So effectively, to the extent you have relied in the past on the NFIP to provide stability in flood-prone regions, especially where private markets hesitate, then now you need to acknowledge the potential for volatility in lending, volatility in investment recovery, and candidly, community resilience. So with that having been said, of course, investor confidence may begin to or need to recalibrate. Something that had thought to be predictable outcomes in terms of credit investing in the space that is now dissipating. If you were to find insurance showing some hesitance in sort of underwriting in the area, and as a result, volatility in underwriting, and also evidence of risk premiums going up, as I referenced earlier, with in certain areas, you will have, or if you have a need for financing in portfolios that are tied to repetitive loss, lenders will react. I think in some ways, you're already seeing some change in behavior, as I referenced before, candidly through homeowners being informed by some of the risks that First Street has identified, more basically through the use of the flood scores. Some institutions, given what I just described and given some of the behavior of some of the insurance carriers, are beginning to pilot enhanced screening protocols. They're starting to discuss covenants tied to mitigation thresholds. Most, however, are watching closely. They're still reliant on legacy tools. I think someone made reference earlier to FEMA maps. They haven't necessarily adopted some of the tools that I've referenced earlier that First Street's provided into their underwriting just yet. But I think the increased uncertainty may change that paradox. Having said that, I'm speaking mostly about in terms of lenders, community banks, and regional banks. You do have more sort of sophisticated lenders, larger organizations, insurance companies, sort of applying advanced structures to sort of reduce or quantify some of the uncertainty I just referenced. What is that doing? It's resulting in an uneven go-to-market. And in that instance, I think there's a hope that private insurers might step in to sort of level the playing field, but that's to be seen. The only other thing I would sort of mention is, to the extent what I just described continues for some period of time, Darren might say you would have what I would describe as sort of pockets of unsurable exposure, where credit decisions are slow, or where institutions might even sort of de facto engage in some avoidance in certain areas. I'll stop there because I don't want to say the dreaded word blue lining or even redlining.
Well, it brings up a good point on just the viability of the private insurance market absorbing the FEMA risk. I mean, Daniel, you in your last comment said, I don't think that they could actually do that. And so whether that is viable or not, but what does that mean for affordability, to what Jeff is also getting at, which is when the prices change dramatically, when the private models are showing a much different risk than what has historically been from the NFIP program, that's when we see big potential swings and big potential credit problems. Jeremy, I know we have spent a fair amount of time talking about this together, so maybe we can have you weigh in here. But based on all the work that you and your team have done in this area, where do you see the greatest concentration of risk, and how do we use this property level data, and also a report from our partners at Neptune, helping to clarify where this exposure may be and what might happen?
Yeah, I think it's a really important point, is to try to quantify what is the issue, what's the size of the issue that we're talking about. And a lot of the work that we've done in terms of developing our own risk-based flood model, sort of free of all of the handcuffs and strings that FEMA has when they're building their flood model, has shown that there's about 2.2 times as many properties across the country with significant flood risk as what FEMA shows. So FEMA shows about 7.9 million properties in their 1 in 100 year flood zone. We show about 17.7, 17.8 in our 1 in 100 year flood zone. We talk a little bit about the differences. FEMA doesn't include heavy precipitation in their flood model directly as a rain on grid model. It does fill the river and ends up being captured by a lot of the river gauges. There are, of course, congressional mandates and other things that come up in terms of the ways in which that flood program works. But the key is that there's known risk across the country and there's unknown risk across the country. And where we see known risk, we actually see that not only are property owners protected, but communities are protected. Our last report, Climate, the Sixth C of Credit, actually showed that in places where FEMA zones were well mapped, where people had insurance uptake post-event, there actually were decreases in foreclosures versus the period prior to the event. In places that weren't mapped well, insurance uptake wasn't as high as it probably should have been. There's probably a lot of unknown risk simply because consumers and homeowners didn't know they had that risk. We saw increases in increases in foreclosures post-event. So, to Dan's point earlier, insurance is a protector of property owners, but it's also a protector of communities. And when you look at where the biggest mismatch in between our known and unknown risk exists across the country, we see a lot of it in areas like the Appalachians. I mean, what we saw in Asheville after Hurricane Helene, something like 2 to 3% of the properties that were impacted in that area had NFIP policies. It's not an area that's mapped very well by our current tools that we use to understand flood risk and the current tools that we use to drive requirements around flood insurance. So it's an area that's not protected. Buildings aren't built to the specification needed to protect those buildings, and homeowners aren't able to recover post-event. That makes its way into the community. And that's where a lot of the work that we do downstream on my team focuses, and is really on, what happens to that community viability as an opportunity zone for commercial investment or for property value changes into the future. And it's hard to pin it back to a single metric, but I think a point you made earlier, Matt, was that insurance gives us the backstop. It gives us the ability to be able to build in certain places, to be able to trust that if a disaster does occur, we'll be able to recover from that disaster. And the risk rating 2.0 change that we saw back in 2021 did increase the cost of insurance. And it was a move in which FEMA and the NFIP program was essentially moving towards a more actuarially sound process for pricing insurance. We saw prices increase under that adjustment in some places like Southern Louisiana, for instance, or zip codes that increased by 800%. There was a grandfathering clause in there where premiums could only rise by a certain percentage year over year. But it's important to point out that the reason why those adjustments were being made was because the NFIP program couldn't keep up with the payouts that were being made given the increase in climate risk and the premiums that were being brought in to the program, even with the grandfathering that we're using now to increase premiums 18% year over year. I think it's something like 15 to 20 years before we get to a place where FEMA still wouldn't be taking a huge loss year after year on an average annual loss expectation against the insurance losses. But some places like Neptune, a private insurer, has looked into this, and as they started looking at pricing actual policies in force across the U.S. Again, there's about 7.9 million properties in FEMA zones, about 4.2 million policies in force in the NFIP program. Ultimately, Neptune found that about 1.8 million of those 4.1 would see increases in their premiums if they were to go to the private insurance market. About 2.7 million, interestingly, would see decreases in their premiums. So the rate at which FEMA is now, or the NFIP is now pricing flood insurance to be more actuarially sound, is becoming is producing a more competitive landscape for private insurers. Still to date, I think Dan made the point that private insurers are taking a larger share of flood today than they had in the past. We're still only up to about 11 or 12% in that space, but that's more than double what it was, less than half a decade ago. So it is growing into in a way that allows the private insurance companies to take a larger share. The last thing I'll say is there's about 235,000 of those policies that Neptune identified that really under their models just wouldn't be insurable given the amount of flood risk that exists. So it's not the largest proportion of properties, but almost 250,000 properties out of the 4.1 million essentially wouldn't be insurable under a private insurance company model.
Hey, Matt, just a point. I would say that for high risk policies under the NFIP program, particularly when banks originally, or I shouldn't say originally, initially started underwriting with that in mind, risk premiums were not contemplated. It was a flat number based on more traditional variables. What Jeremy now talks about is a dynamic premium that would reflect the risk undertaken. Underwriting in most instances didn't contemplate that. So banks overnight may find themselves in a situation where affordability, creditworthiness, and other sort of measures of riskiness that were not undertaken previously now are factors. And I would just sort of say, from a practical perspective, I'm not sure most of the industry is ready for that.
Yeah, and it's the role of the private insurance question as well to me on historically there's been the safe backstop of the federal government that we can always count on. And so now if we theoretically play this out to your point, Jeff, like it wasn't included before, and now it's something that should be contemplated, or Jeremy's talking about the delta between some of these things. A real question is whether the uncertainty in the private market performance would affect vulnerable communities and local resilience planning, because it is net new versus FEMA can be counted on. If you lose money in a given year on payouts, as Jeremy's talking about, you can count that it'll be there. Where private companies are much different. They aren't afforded that benefit of being able to go back and actually receive more money from the federal side. So Dan, when we think of this from a perspective of the uncertainty in the private market performance, can the private sector reliably replace that safety net? I know in theory you were saying it couldn't do it all together and all at once because it would take a really long time. We'd have to go year on year planning and capacity building and all those things from a recovery fund. But what about on the insurance side, on the private side?
Yeah, I think the short answer is it depends. It depends what we're talking about. If we're talking about individuals, if we're talking about governments, if we're talking about flood or broader property. So I think one topic we haven't talked about yet is the broader property landscape. So just fact, most public infrastructure and public buildings are uninsured. Rather than buying property insurance, many of these communities explicitly plan to absorb minor losses. And for anything that's catastrophic, that's beyond their means, they're hoping, praying that they'll get a federal, presidential disaster declaration and federal dollars will flow. And so under the current system, it sets up this odd, disincentive for communities to be financially resilient for their own infrastructure, for their own buildings. So you could almost think of FEMA public assistance as a no limit policy with at most a 25% deductible, and they're paying nothing, zero premium. That's what FEMA public assistance is to local communities. And so, and if you want to dive even deeper, category E, one of the categories of public assistance is for public buildings, because the pushback I imagine is, well, insurance could never cover all of those losses, or it's not applicable. You can't get a policy for a road, or a bridge, or yeah, but you can for public buildings. So category E is public buildings. Right now, communities aren't even getting property insurance on their buildings because they're rolling the dice and hoping, if it's bad enough, FEMA will reimburse them. So that's one issue. And I think that you would see, FEMA rolled back reimbursement for some of those categories of assistance. I think you would see the insurance industry move in. And now, could they fully fill the void or not? I can't answer that question. It depends on what we're talking about here, the scale. If we're talking about every piece of infrastructure in America, no. I mean, I don't think there's enough capacity in the insurance market. But if you're talking about public buildings, I think there's a real possibility the insurance industry could fill that void. And even if you're talking about for individuals, the individual assistance programs that FEMA provides to the uninsured, the safety net program, there are innovative products in the market that are attempting to help fill that void. One of them is our product, community-based catastrophe insurance. And community-based catastrophe insurance means a community, a local government, purchases insurance on behalf of its community members. And usually it's not a traditional policy. Usually it's a parametric structure, meaning it pays out if an event happens, as opposed to having to adjust each of those individual properties. It's just a fixed payment. And the reason I mention that is, one, because there are innovations coming to the market, that one for individuals, but you could equally apply a parametric solution to infrastructure, for example. Again, with the caveat being there may not be insurance capacity to cover every single piece of infrastructure, but there are ways the insurance industry can and does play a role in providing some financial protection today. And I believe that could expand in the future if there was a pullback from FEMA.
And so I'm gonna skip ahead to one of the final questions we have, because it's been a great conversation, but we want to spend some time with the questions from the audience as well. But the last one that we had as a discussion item, I think is really important to hit on, and we've talked about it in and out in some of these answers from every one of you. But when I think about it, the big question to me is, what are institutions doing? Are they using property level risk data to quantify this exposure and risk mitigation strategies, or are they doing something else, or are they thinking about it broadly? Are they ready for what's coming? And so, Jeff, I guess to you specifically in the financial sector, are they beginning to incorporate climate risk in mortgage underwriting and capital reserves? You talked about this a little bit, but I would love for you to kind of go into detail and talk about what some potential blind spots might be.
Yeah, sure. I would tell you, and I say this in tongue in cheek, reluctantly, because spending money on enhanced analytics is loss reducing, we think. Is it revenue enhancing? We'll save that for another day. But property level climate analytics, I guess, are gaining traction across the financial sector. But I would categorize it as the adoption is candidly uneven. Many institutions are still, dare I say, I'll just say, remain early in the journey. And that has a lot to do with the fact that for a long time, FEMA gave you county level data. It was good enough because it came from the federal government, and you just didn't have frequent events to sort of make you question the reliability. Well, obviously, the reason in part for this webinar has changed that dynamic, and what happened in 2024 and late 2023 magnified or sort of exacerbates the point. So where's progress really occurring? In some organizations, you have underwriting now starting to take place, and I underscore some, with forward-looking data. So again, not necessarily a commercial, but just a statement of fact. You have, the flood factor scores and other models are being used, in some instances to adjust loan terms, but that's sort of advanced practice. And they also might screen for insurability, or, we heard earlier about, resiliency. So they might, sort of structure mitigation incentives, following some best practice you now see in insurance companies, where they now go into sort of composites of roofs and other sort of structural factors as a mitigating item. But most, candidly, are not. I think the adoption varies, but let me be optimistic and say, from a portfolio risk perspective, momentum is building. A few banks are layering in climate-adjusted risks into CECL reserves, and some, are taking advantage of the ability to sort of do some scenario modeling, 2035 or 2050 scenarios, to capture the potential loss volatility that portfolio managers think about. Blind spots, look, reality is valuation misalignment remains a challenge. I talked about it earlier. Think about the fundamentals of how the market performs. Many appraisals rely, on historical comps without incorporating future exposure. In high-risk Midwestern counties, the gap between automated value models and climate-adjusted pricing can exceed, 18, 20%. Regulatory frameworks don't yet fully reflect climate differentiation. Some people think that's a good thing. I think it's exacerbating the issue. Capital reserves requirements don't differentiate between mitigated and unmitigated properties. I would say, despite maybe differences in performance, and we're starting to see that happen. And I would say, clearly, smaller organizations lack the data access to even do anything that I just talked about. Some of the surveys I've seen suggest more than 2/3 of community banks don't even use climate analytics for any credit decisioning. So if climate is going to be managed, what I would say equitably, we'll need to sort of adjust for better data. And thank you for the opportunity to talk about it. We'll need to sort of set and establish shared standards to ensure, equitable access for the tools. That's another issue for another day. And then, although for now we think we have regulatory clarity, given my comments, maybe not so much in order to see resilience sort of take hold in the market. So hopefully that's helpful, Matt.
Yeah, absolutely. Jeremy, obviously we work with a number of financial institutions and investors. Is that a similar thing that you're seeing? If you could just give us a couple comments on that, and then I have a great question from the audience. We'll start pouring those in.
I'll be quick. I won't keep us from the audience.
I don't trust you, Jeremy. I don't trust you.
I do. I mean, consumers are making decisions, right? We're seeing that people are making climate informed decisions more and more than what we've seen in the past. A lot of it has to do with the fact that this data is publicly available in a way that it hasn't been in the past, and we're seeing that drive property valuation. Sometimes it's a longer term lag associated with it. Sometimes it isn't something that shows up right away. Sometimes it's driven by increased insurance costs. But we're seeing these dynamics start to play out in the market. And then what we're starting to see from larger commercial investors is that those community level health metrics around, population growth, GDP growth, HPI growth, the types of metrics that they really pin their investment decisions on are starting to follow some of those trends associated with climate informed decision making by consumers. So I think that there are certainly trends that we're starting to see both in sort of the consumer space, the commercial investment space, the portfolio analytics space, as we saw from our last report. But I also think that we're at the very, very early stages of it. And as the data gets more and more integrated, awareness continues to increase, I only suspect that we'll see more and more of an impact and potentially more and more opportunity, depending on how you view climate data.
Amazing. So here's an interesting one, and I don't know who's the best suited to have an answer, because I think all of you will have a different perspective. But if FEMA and the NFIP were to be dissolved, who is most likely to become the arbiter defining flood insurance requirements, or would there not be one? And this is interesting from a banking perspective on how you would look at it. It's interesting from multiple different ways of looking at it. But what would actually happen? Would the SFHAs, the special flood hazard areas, exist? Would they still be used? You can see where all of a sudden the ripple question, it goes wide and far pretty quickly.
Well, certainly the special, hazard flood areas would continue to exist. I mean, I think it's a different process from what we just talked about. But this notion that I talked about earlier of what I would describe as uninsurance gaps, where you have areas that are uninsurable because there is no lender of last resort, or there is no sort of a public good provider of support. You would now need to simply, when you're not able to quantify the risk, avoid it. Now, am I talking about sort of violating some of the sacred principles of lending in terms of CRA obligations and redlining and blue lining? I'm talking about risk-adjusted decisions, but that's sort of an instinctive response. I think clearly banks also have an opportunity, an obligation rather, for community resilience. So that might put the onus now on municipalities to support enhancements that might create a market for banks financing resilience like mitigation in individual housing. but these are all hypotheticals. But to your question directly, it would mostly harm communities of high risk characteristics.
Dan, I have one for you that I know is going to be close to home. Without BRIC, within this current situation within the NFIP, what can be done to encourage people to mitigate buildings and preserve community and tax bases?
Yeah, I think federal grants are the most obvious, right? So if it's not BRIC, maybe there's a successor to BRIC. That's what we can hope for. But in the absence of federal funding, some of the examples I use, there are states that have wonderful incentive programs. Alabama's program has been replicated in a number of different states now, which is really encouraging to see that states are taking this proactive approach. But it's also private industry. I think all of our industries and all of our organizations have a role to play here. First Street, obviously, on risk assessment and helping individuals and homeowners understand what the risks they face. The banks, like Jeff represents, helping them understand their role and how they can benefit from this. I mean, and in my industry, in the insurance industry, it's the same thing. In fact, one of the terms that I like using about all of us is that we're co-beneficiaries of these resilience investments. Regardless of who makes the investment, it's the individual, the federal government, whoever makes that investment, we are all benefiting, right? And I think the key is to make sure that we educate ourselves, our industries, to understand that we will benefit if we can help that consumer make that right decision. And if there are forward-leaning, members of the finance, insurance, and real estate industry, just like those developers in Babcock Ranch that I mentioned, that's good for everyone. It's good for the person that lives in that home, but it's also good for the taxpayer because federal funds aren't going to be needed to pay for any losses there. And if there's no damage, the insurer is not going to sustain a loss either. So I think ideally, we need to construct a way to kind of pull together this ecosystem of co-beneficiaries and help point everyone in the right direction, the consumer, the client, the community member, to incentivize a decision made at their individual home level, at the community level. And I can say emphatically from the insurance industry standpoint, we need these communities, these local governments, and consumers and homeowners and renters to view their insurer, to view their insurance agent, their broker, as their trusted risk advisor. I want the insurance industry to be viewed in a way that that consumer, that local government, they can look to us and ask these questions about, hey, how can we reduce our risk? Now, likely those questions come in as, how can we reduce our premium? But to me, that's the same as, how can I reduce my risk? And I think it's up to us, to my industry, to help educate consumers and educate governments on how they can reduce their risk, because we all benefit.
It's a great way to close, Jen, because it's kind of back to the answer that you had for your first question, where you had the concept of locally educated, state mandated, federally supported, everyone kind of working together on this. The same concept in the private industry exists, where how do we support each other throughout this? How do we have experts, the right data, provide that knowledge to the next level and make risk-adjusted financial decisions? And the basis of why we exist at First Street is connecting climate and financial risk. So with that wonderful ended statement, I'd love to thank our three panelists. Thank you, Dr. Kaniewski, Dr. Porter, and Mr. Weaver. Lovely experts. There was tons of questions. I'm sorry we didn't get to them all. Well over 100. We have well over 1,000 folks that were on the panel or on the webinar as well, listening to your advice today. So thank you for contributing that. We'll send out a recording after this to those interested, and hopefully I see you gentlemen sometime soon. With that, we'll say goodbye for now. Thank you everyone for attending, and we look forward to see you at the next First Street webinar.
Thanks, everybody.